You're watching this video series with the intention of learning a lot about the stock market, how to make money from it, and so on. Well, what is the stock market? The stock market in its current form is an electronic exchange where investors can buy or sell shares of a company, kind of like a giant marketplace where the only thing for sale are shares of stock. When you buy a share in a company, you are actually buying a piece of that company. So now that you own a share, you're counting on the company to make lots of money so that your shares of stock increase in value. Similarly, if the company makes no money or even loses money, the value of your share will decrease. And so the stock market consists of a great deal of investors who are looking to buy shares of companies that will perform well into the future and sell the shares of companies that will perform poorly. If you happen to be good at forecasting the future, you can make a great deal of money in the stock market. In Section 3, I will talk about some of the common strategies that myself and others use to try to predict which stocks will go up and which ones will go down. It is important to have a firm understanding of what determines the share price of a stock. We'll get into ways of calculating value in Section 3, but for now, all you need to know is that the market determines the share price. That is, the price is determined by what investors are willing to pay for a particular share. As of writing this, a single share of Google is valued at over $1,100, whereas a single share of Microsoft is hovering around $36. I want to be clear that these prices do not say anything about the value of the company itself. Rather, these prices are merely a function of what the investors in the market are willing to pay for it. And so the fact that shares of Google are trading at over $1,100 means that collectively investors in the market think that one share of Google is worth over $1,100. Human emotion and psychology play a significant role in the pricing of stocks. This is a very important concept that I'd like you to always remember because people can and do have poor judgment from time to time and end up paying too much or too little for any particular stock. There is a lot of money to be made if you can figure out when a stock is over or underpriced. In addition to stocks, there are other financial instruments I'd like to mention. I won't go into great detail in this series because I personally only trade stocks, but I think it's important to be aware of what else is out there. I'm sure you've heard all about bonds before and possibly options, derivatives, and money markets. Bonds are fundamentally different from stocks in that they are a debt instrument, whereas a stock is equity. In the most general sense, debt. In this case, a bond guarantees the bond owner a claim on the value of that bond. For example, if you own a bond with a face value of $1,000, you would expect to be paid back $1,000 by the company that issued the bond. On the other hand, owning equity, in this case common stock, does not entitle the owner to anything. In other words, purchasing a share of Google for $1,000 does not mean the company owes you $1,000. It's a strange concept to understand, but ties hand in hand with what I was speaking about earlier. That is, the value of the stock lies only in what other people are willing to pay for it. Now you might be wondering why anyone would buy a stock if they weren't guaranteed the amount of money they paid for it. Well, the answer lies in the methods that people have developed for valuing the worth of a stock, a topic we will discuss later. Options and derivatives can be confusing to talk about at first, so I won't dive in here. All you have to know is that there are complicated ways of trading the stock markets and don't require an investor to actually purchase the stock in a common sense of the word. If you are new to the markets, I repeat, do not trade options. You can end up losing a lot of money if you do not know what you're doing. There are two terms you should be familiar with to understand money markets, and those are liquidity and maturity. In finance, the liquidity of something represents how quickly and easily it can be converted into cash, with the basic assumption that cash itself is the most liquid asset of all, and that a $1 bill can always be traded for another $1 bill, whereas a house, for example, is not very liquid because it takes a great deal of time to sell for cash, and that the price is usually negotiable. That is, a house valued at $500,000 might actually be sold for $480,000. When we talk about maturity of things in finance, we're referring to the length of time the instrument is outstanding. The U.S. government regularly issues treasury bills, commonly referred to as T-bills, with varying maturities ranging from 1 month to 6 months. As a new investor, the only two money market instruments you need to concern yourself with now are T-bills and certificates of deposit. Certificates of deposit, or CDs, are generally issued by a bank and have varying maturities. The basic premise is that you hand over $1,000 today and the bank agrees to give you your $1,000 back plus interest at the end of its maturity. Let's quickly recap what we've just learned. The stock market is an electronic exchange that allows you to trade shares of a company with other investors. By buying low and selling high, as they say, it is possible to profit off of these transactions. The price of a stock it is bought and sold at is constantly changing, second by second, and is determined how much an investor is willing to pay to own a share. This is the idea of supply and demand. There are a number of other tradable financial instruments such as bonds, options, and derivatives that are good to be aware of, but we won't discuss frequently in this video course. Money market instruments are very liquid, that is easy to be traded for cash, and have short maturities. The two to be familiar with now are T-bills and CDs.